Very good morning. I'm Heidi Stradwatts in Sydney. We are counting down to Asia's major market open.
I'm Sherry in New York. Welcome to the Break Asia. Our top stories this hour. The Fed raises rates by 50 basis points and signals similar steps ahead.
There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings.
Asian stocks set to follow Wall Street higher as investors breathe a sigh of relief. The supersized hikes may be avoided. Plus, Jamie Dimon criticizes the Fed for moving too late, warning there's only a 33% chance of avoiding a recession. Take a look at U.S. futures under pressure right now, down 0.2%. But this, of course, after we saw the rally in the New York session, the best day since May 2020. In fact, after the FOMC statement, stocks really struggled for direction, but it was during Chair Powell's press conference that we saw a move significantly higher with the Nasdaq 100 and gaining more than 3% at the close. We also had the dollar index really seeing the biggest drop in about a month or so. This, of course, as long positions were cut after Chair Powell really downplayed the idea of a 75 basis point hike. Now, we are seeing crude prices paring back some of those early losses in the Asian session and, in fact, extending those gains that we saw in New York. Remember, we had the best gain in about 3 weeks, not only because U.S. regional fuel inventories fell to record lows, but because the EU continues to threaten a ban on Russian fuel imports this year. But, of course, the action really in the Treasury space, right? We saw the Treasury's bull steepen with the 2-year yield, in fact, falling below that 260 level at one point. The 2-10s 530 spread, in fact, steepening more than 10 basis points as that press conference by Chair Powell was taken by the markets as more dovish than expected, Heidi.
And Jerry, we are expecting that relief rally to play out across Asian markets rejoining trade today, including Australia, where futures are looking like about 0.5% of gains when we get into the start of cash trading, snapping 3 days of losses there. We saw the Aussie dollar continuing to strengthen overnight, although we are paring back maybe some of those gains. It did put on over 2%, and leading those gains we saw in the G10 space as we saw the Dixie, of course, the biggest intraday tumble since March 9 there. Kiwi stocks up about 0.7%, and we heard from Governor Orr saying that the RBNZ was courageous to begin tightening and by such a big amount before many of its peers. And we're also, of course, watching the currency front from the perspective of the Kiwi dollar as well, seeing a little bit of weakness as that Aussie-Kiwi pair continues to plough ahead with that strength. But take a look at what we're seeing across fixed income. This global bond rebound is really underway with Australian bonds roaring back in the morning session, just unwinding some of the pressure that we've seen from that 5-day slump there. The 10 almost surging 50 basis points, if you recollect, in just a week after the RBA delivered that first rate increase since 2010. Also watching that 3-year, it's now back under 3%. Of course, it went through that level for the first time in 8 years, and we're seeing a little bit of pressure coming off the selling there as well after that 75 basis points was taken off the table, Sherry.
And Heidi, we are seeing the Hong Kong Monetary Authority also following the Fed raising the base rate to 1.25%. Now, remember, the rate moves in lockstep with the Fed's rate increase, given that the Hong Kong dollar is pegged to the U.S. currency. So this would be the second hike this year following the Federal Reserve. Now, the Hong Kong Monetary Authority raising its benchmark by 50 basis points. The base rate was increased from 1.25%. This as it follows the Fed, given the Hong Kong dollar is pegged to the U.S. currency. But let's really delve into the Fed's most aggressive tightening campaign in decades and bring in our global economics and policy editor Kathleen Hayes and our cross-assets Asia editor Andrea Papuk. Kathleen, let me start with you, because I mentioned earlier that at least when it came to the markets, it seemed that they took the presser as more dovish than they had expected. What is your take of the hawkishness of this decision?
I would say if you put it in more objective terms, certainly market expectations are always important. But what they actually did to make the first 50 basis point rate hike in, 22 years, the first since the year 2000, when Jay Powell made it very clear there's going to be 2 more of those, still pretty hawkish, even if he's not on board yet with a 75 basis point rate hike. Let's listen to what he said in answer to a question.
75 basis point increase is not something the committee is actively considering. Assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the
See itself in this policy statement. It's about 5 paragraphs. This is where they are very careful about what they're messaging, and they said that the ongoing increases in rates will be appropriate. When Jay Powell spoke about inflation, he said it's much too high, and the Fed is going to move expeditiously to bring it down. Obviously, he's putting inflation over the economy at this point. He does think the strong labor market, the hot labor market, could cool off a bit. If rates are above the neutral rate, which he says the Fed on average is figuring is about 2 to 3%, and more rates hikes are required, quote, we won't hesitate to deliver them. We're a very long way from neutral now, he said as well, again, indicating that he can see this just isn't a couple of 50 basis point rate hikes and let's see what happens. This is a steady path they appear they're going to be on. He thinks the economy can handle tighter policy, good chance for a soft or softish landing. I love that wording. The balance sheet reduction is getting underway as well. So, Heidi, to me, this is definitely, it isn't just a hawkish pivot. They pivoted back at late December, January, moving into March. Now these are the hawkish steps. 75 basis points is not being discussed now. He didn't say they'd never discuss it, but it's not on the table yet. I'd still say this is a pretty definite message.
Andrea, for the markets, it felt a little bit like they got themselves into a tizzy over the 75 basis points and those expectations that were built, right? How big is a relief rally that we expect to see?
Look, that's right. A lot was riding on Jay Powell's presser. And look, markets went in at peak hawkishness. You know, there are questions, was this a myopic reaction, if you like? They really latched onto that one nugget of 75 basis point and they ran with it. As someone mentioned, it was like throwing investors a breadcrumb. We are seeing a little bit of a reality check with the US futures here in Asia, you know, coming off a bit after those gains. Because, you know, questions remain. You know, some of the notes that I'm seeing this morning, investors are saying, you know, are markets putting too much faith in the Fed's ability to bring inflation under control, to engineer a soft landing? And these are questions now that, you know, are coming out for investors. So look, we are probably going to see a relief rally in Asia. It's definitely not an indication of what we're going to see in a week's time. As we know, there are a lot of uncertainties out there for investors. And also worth noting that we do have China reopening after that break. And there are a lot of questions about how the government is handling the lockdowns.
Right.
Can the government convince investors that the lockdowns you know, are not going to impact growth there?
And we have already started to see the reaction in the bond space, right, with Aussie yields plummeting. What are we expecting there?
Yeah, look, Aussie yields are basically tracking those gains that we saw in the U.S. bonds last night. But, you know, U.S. bond futures are looking a little bit, you know, quite steady this morning. We don't have cash trading because of the holiday in Japan. Also worth noting that real yields and those break-evens did not move last night, and that's what investors are going to start focusing on. They are going to be looking at those real yields. You know, are they going to edge up? Are they going to bring those inflation break-evens down? And you know, which in itself will ease pressure on inflationary expectations. So look, we have seen rate markets wind back those expectations for a more aggressive rate increase. And again, that's supportive for risk asset right now, but it does remain a very murky picture going forward.
Bloomberg's Andrea Papuk there and Kathleen Hayes. Let's get to Vonnie Quinn with the first word headlines. Vonnie.
Heidi, thank you. JP Morgan CEO thinks the Fed should have moved faster in raising interest rates. In an interview with Bloomberg Television, Jamie Dimon said the economy is very strong and he sees a 1/3 chance of the Fed's actions leading to a soft landing, but he also added that he sees the same chance for a mild recession.
Businesses are in very good shape, and the Fed is going to have to raise rates and reverse QE. And they're going to, you know, if they can, they're going to try to slow down the economy enough so that 8% starts to come down over time. And I wish them the best. Yeah. You know, we're a little late, but, you know, remember 2 years ago we had 15% unemployment and no vaccine. So I think people should take a deep breath give them a chance, and I think they're going to move. I think the sooner they move, the better.
Brazil's central bank raised its benchmark interest rate by a full percentage point to 12.75%. That move was for a second straight meeting. It also signaled another hike of smaller size may come next month as policymakers seek to contain the country's rampant inflation. Brazil has raised borrowing costs by a total of 10.75 percentage points since March 2021. India's central bank surprised markets with a 40 basis point hike to tame inflation. In its first unscheduled move since the pandemic began, the RBI raised its key repo rate to 4.4% from a record low. The central bank also raised the cash reserve ratio by 50 basis points. Governor Shaktikanta Das said that inflation pressures are becoming more acute, particularly on food. The European Union is planning to ban Russian crude over the next 6 months as part of a 6th round of sanctions aimed at Moscow. In addition to phasing out all Russian oil, the bloc's 27 members are also discussing extending that SWIFT ban to more banks and banning property transactions with Russian citizens and entities. Sources say Hungary and Slovakia could be granted a longer time frame to cut their reliance on Russian energy. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Vonnie Quinn. This is Bloomberg. Sherry.
Right, Vonnie, still ahead. Despite inflationary risks and a hawkish Fed, Riverfront Investment Group says it's important to weigh all the components before throwing in the towel on the U.S. economy. But first, we discuss the Federal Reserve's rate hike with the former Philadelphia Fed President Charles Plosser joins us next. This is Bloomberg.
This week, April jobs are in focus.
It's a very, very good labor market for workers.
The demand for labor, obviously, much stronger than the supply.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
As long as the numbers hold up, the Fed is going to feel encouraged.
Then 75 in June is certainly not out of the question.
To me, the question is, are we fully employed?
The elephant is the war in Ukraine.
The April Jobs Report, Friday on Bloomberg Television and Radio.
Inflation is much too high. We need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. 75 basis point increase is not something the committee is actively considering. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. If that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. If higher rates are required, then we won't hesitate to deliver them.
Fed Chair Jerome Powell is speaking after that FOMC decision. Let's bring our global economics and policy editor Kathleen Hayes, who's standing by with our next guest. Kathleen.
With us now, Charles Plosser, previously served as the Philadelphia Fed Bank president. So he's been there and done that. He's had to deal with all of these questions himself. Charlie, it's great to have you back. The markets always great to have you. The markets reacted to the Powell saying we are not looking at a 75 basis point rate hike right now. On the other hand, they did a 50 basis point rate hike and see 2 more at the next meetings. They haven't done that since the year 2000. To you, is this a hawkish Fed? Is it a dovish Fed? Is it a Fed that is on the right track?
Well, it's not a hawkish Fed. I mean, they've put themselves in a position where they had to do this. This is kind of a problem of their own making. I thought Powell today spoke very eloquently about inflation, about the dangers of inflation, why the Fed needed to act. I don't know where that Powell was 12 or 18 months ago when he said they didn't have to worry about inflation for at least 2 or 3 years, that the Fed should keep it at zero, keep rates at zero and not worry about inflation. I hope he's more accurate now than he was then. So I think they did exactly what everybody expected them to do. I think the question is this enough?
Well, you took the words right out of my mouth. Is it enough? We just ran that soundbite from Chairman Powell saying that they're willing to move rates higher than needed, willing to go above the neutral rate. He says it's an estimate, somewhere 2 to 3%. Is that going to be high enough, even if they do go above neutral?
Well, I don't. People mean different things by neutral, but the definite between 2 and 3%, I don't think is high enough. I mean, if inflation is still sitting at 4 or 5%, even if it comes down from where it is now, which I expect it to do, it's not going to be at 2% by the end of the year. So they're going to be looking at a 4 or 5% inflation rate at the end of the year. That means that real interest rates are still deeply negative, even if they get to 2 or 3%. But the real rate will still be minus 2%. That's very accommodative still and not very restrictive. So I don't think that's enough. Will be enough at the end of the day. I mean, if inflation comes down, maybe they'll get a reprieve. We don't know that, but I think it's misleading, I believe, to sort of talk about the neutral rate as if that's enough to bring inflation down.
Does that
by
mean
any traditional standards, it won't be.
That actually, in fact, 75 basis points hikes are still feasible?
I think they are, and I think that the Fed, I think Powell was a little bit playing the markets or trying to appease the markets with this. I don't think he should have taken 75 basis points off the table, as many people have interpreted. I think they need to be still on the table, and that the Fed ought to have that option.
So in that case,
I think they still are on the table.
Right. So if that's the case, have they dug themselves a bigger hole in terms of market expectations?
Well, they may have. I mean, they dug themselves a big hole 2 years ago when they adopted their new strategy that said that inflation was not going to be a problem. They could keep rates at zero for 2 or 3 years. They dug a hole for themselves there. And frankly, if they had done what many people, myself included, suggested they do, is begin tapering the purchases and getting on with rate increases a year ago, they wouldn't be in this position of having to raise rates 75 basis points or disrupt markets with rapid increases. It reminds me of the old, what we used to call go-stop policies of the Fed, where you step on the accelerator to boost the economy and boost employment, only having to slam on the brakes to stop inflation.
Okay.
That's the policy they seem to be practicing.
Charlie, at this point, is it possible for the Federal Reserve to slow the economy? Powell talked about the hot labor market possibly cooling off. He said getting inflation down is challenging, but there's a chance of a softish landing. Can the Fed achieve that, or is a recession pretty much inevitable at this point?
Who knows? I mean, the Fed could get very lucky and achieve a sort of somewhat soft landing. I don't know the answer to that. But it's a very fine needle, and it'll take a lot of luck, I think, not just a policy decision, but luck in order to achieve that at this point. There's just no record of the Fed raising rates to minus 2% in real terms and stopping inflation.
So the balance sheet runoff, Charlie, that's going to start.
Highly unlikely.
Yeah, the balance sheet runoff is going to get up to about $95 billion a month. What is it? 60 in Treasury, 60 billion, and 35 billion in MBS. It's going to take about 3 months to get there. Is this going to make a difference in how much they need to raise rates? I know Jim Bullard from the St. Louis Fed and others have sort of talked about this. What's your sense of how that's going to work, and if aggressive balance sheet runoff could augment the amount of rate hikes they seem ready to do right now?
Well, I think that's very dubious. Powell today said he didn't know. They don't know what the effect of the balance sheet runoff is in terms of rate hikes, or they hope it works, but there's no way to be sure. And frankly, the runoff that they're talking about probably won't be achieved for some time. After all, as interest rates go up, they have $2 or more trillion worth of MBS sitting on their balance, $3 trillion of MBS sitting on their balance sheet. Repayments and refinances are going to cut down the runoff of those MBS securities, which are all 30-year, mortgages. And so what's going to happen is that they're not going to achieve that $17 or $35 billion of runoff. And so the balance sheet is not going to shrink as much as they're anticipating. And it will become more heavily MBS, subsidizing the housing market, which is another problem they'll have in terms of the credit allocation problem.
Yeah,
so I think they need to be prepared to actually sell assets, would be my both MBS and treasuries.
More skewed towards the housing market, as you were saying, but really how much does that also complicate the picture, given that we continue to see the frenzied market, and despite mortgage rates rising, given the lack of housing inventory, that's not really cooling off?
No, it's not. In fact, I could never really understand why they were buying MBS in the first place during the pandemic. The problem was not in the housing market. So I think this is just another problem that they've created for themselves about how they unwind themselves from this type of credit policy and large balance sheet that they've created.
Charles Plosser, always great to have you with us, the former Philadelphia Fed president. We appreciate your time with us today. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Of course, it is all about the reaction to the Fed. Terminal subscribers can get caught up at DayBgo. This is Bloomberg.
And here's a quick check of the latest business flash headlines. National Australia Bank's first half profit beat analyst estimates on the fastest growth in corporate loans since 2008. Cash earnings climbed to $2.5 billion in the 6 months ended March 31st. That just topped average analyst estimates. The bank will pay an interim dividend of 73 Australian cents per share. Uber has delivered a positive earnings outlook, signaling plans to capitalize on robust ride demand by focusing on product changes, not incentives, to curb driver shortages. Its guidance comes after first quarter revenue rose 136% to $6.9 billion. EBITDA earnings came in at $169 million, above the average estimate of $135 million. Lyft lost nearly a third of its market value on Wednesday after the company's second quarter outlook and plan to increase spending on driver incentives disappointed Wall Street. The company's shares closed down almost 30% in New York, its steepest ever drop in a single session. The stock is now down more than 70% from its record high.
Well, coming up next, Riverfront Investment Group has reduced its exposure to financials despite the rising rate environment. We'll talk through why with their senior market strategist, Rebecca Felton. This is Bloomberg.
Businesses are in very good shape, and the Fed is going to have to raise rates and reverse QE. And they're going to, if they can, they're going to try to slow down the economy enough so that 8% starts to come down over time. And I wish them the best. Yeah. We're a little late, but, remember 2 years ago we had 15% unemployment and no vaccine. So I think people should take a deep breath, give them a chance, and I think they got to move. I think the sooner they move, the better.
Going back to the 1930s, we have never been able to reduce inflation by more than 2.5 percentage points without inducing a recession. So even if we don't get close to the 2% target, it's very likely that we will have some kind of an economic slowdown well before we get to the desired inflation target.
at Guggenheim, Scott Miner, alongside JP Morgan CEO Jamie Dimon, speaking exclusively to Bloomberg. In fact, we'll hear more from Jamie Dimon in a few moments. But first, let's discuss the Fed's rate hike implications on markets with Rebecca Felton, senior market strategist at Riverfront Investment Group. Rebecca, good to have you with us. So, first of all, just give us your reaction to the Fed's decision, their guidance on what sort of rate hikes we should expect, and also how the markets reacted.
Well, thank you so much for having me. And I think it was a collective sigh of relief across the board today. We had expected that they would announce a 50 basis point hike. Everybody was very concerned about the 5 basis point hike later on. So I think that this was a good move from the Fed to ease into the next phase of tightening and keep markets calm in terms of the language.
And yet there are concerns that perhaps the Fed is behind the curve, which is why we continue to hear about the potential recession coming very soon. And, of course, inflationary pressures would really have hurt consumer sentiment recently. Does that affect your positioning?
Not so far. Obviously, we've seen some up and down data points as it relates to both the Conference Board data as well as University of Michigan data. But at the end of the day, they haven't fallen off in terms of the data themselves. And also, consumers are still spending money, not just on goods, but also on services. We're seeing a return to travel, enjoying eating out, sporting events, music, concerts, and those sorts of things. So even though they're saying that they're worried, their pocketbooks are still open and they're still spending money, which is very encouraging. And of course, that was one of the most encouraging pieces of last week's GDP number.
The rebound in fixed income in bonds globally, but as we saw beginning in treasuries, is that sustainable, and does that give a little bit more of a buffer for sentiment when it comes to stock investors as well?
Well, it has certainly been an unpleasant year for bond investors, seeing those negative returns and not being used to that. We believe the worst is over for fixed income investors. We've spoken before that Riverfront has been underweight fixed income. We still are. We've added back a little bit in our longer horizon portfolios. We're playing it through high yield, and in the shorter ones through bank loans. But we believe that we will start rethinking that positioning here in the near term, and that these are going to be more attractive asset classes in our balance strategies very shortly.
In terms of the worry over inflation, where are you finding some of the inflation hedges at the moment? And does the rebound that we saw overnight sort of encourage investors to take a bit more cash off the sidelines?
Well, I think it does. And we are of the mind that actually long-term investors are probably best suited to staying in equities as a hedge against inflation, quite simply because obviously you have the potential for not only price appreciation but dividend growth. We have seen a fair number of companies in the S&P 500 just in the last few weeks as we've moved through earnings season increase their dividends. And so we believe that is probably for most folks the best way to hedge against inflation.
Rebecca, we have heard other investors talk about how smaller companies may be able to navigate this environment better because they are less exposed to global macro uncertainties. What do you think?
Well, unfortunately, what we're seeing, and we just saw it in the ADP numbers today, we actually saw job cuts from small businesses because they're having the pricing pressures, the inflationary pressures are impacting them more. As well, they're having difficulty finding qualified labor. We've heard about the labor shortages, and now, of course, the pricing pressures are starting to impact, and we saw that played out in that ADP report today as it related to the small business segment. So we're watching it closely because it is such a huge part of private sector employment, and they are obviously having a difficult time right now.
Rebecca, always great to have you with us. Rebecca Felton, Senior Market Strategist at Riverfront Investment Group. We'll have more from our exclusive interview with Jamie Dimon now. He says the Federal Reserve should have moved quicker to raise rates as inflation spiked.
Very strong U.S. economy.
Yeah.
Consumers in great shape, lots of money, spending the money. Jobs are plentiful, wages are going up, though everything's distorted by inflation and all that, but those are good news, and businesses are in very good shape, and the Fed is going to have to raise rates and reverse QE. And they're going to, if they can, they're going to try to slow down the economy enough so that 8% starts to come down over time. And I wish them the best. You know, we're a little late, but you know, remember 2 years ago we had 15% unemployment and no vaccine. So I think people should take a deep breath, give them a chance, and I think they got to move. I think the sooner they move, the better. So yeah, they're going to be raising rates.
Deep breath, but what could go wrong? I mean, you talk about, you know, strong U.S. consumer, strong business. You talked also about storm clouds. What are those storm clouds, well, and what's worst case scenario? Right?
Yeah, I hate the word unprecedented, but there's kind of fiscal and monetary induced unbelievable growth in the U.S., which was true around the world, though it's obviously slowing down in Europe. That's abnormal. We've never really quite had that before. We've never had QT before. So, you know, you look at QE, that's one of the greatest experiments ever done. They're going to be writing books for 50 years on it, and we're going to have to reverse it. And that's a huge change in the flow of funds over time around bonds and rates and stuff like that. My own view is that rates will still have to go up from here. And then you've got Ukraine, which, you know, I think is a potential, you know, when you look at Ukraine, obviously the wishful thinking is we have a Fed-induced slowdown works. The world is fine, Ukraine resolves, but there's a chance that this goes on for years and you completely rattle global energy markets, wheat markets, commodity markets, and you know that. And we need, as you know, the Western world needs to be prepared for that and needs to take every action today to be prepared that that can get really bad tomorrow. And you know, when it gets really bad tomorrow, you don't have time.
So how do you handle that? What's your plan B if it does go all pear-shaped?
I like the fact that it will deal with it. You know, I mean, that's life.
But how?
I mean, I like in my view, the most important thing is American growth, and that America, you know, I call it this Marshall Plan for energy, that we do everything we can, and this doesn't violate climate change, it doesn't change anything about long-term objectives, but that we do everything we can to get oil and gas into the hands of Europeans so they don't freeze in the winter. You know, and again, I'm not saying it's going to happen, but you know, you have a couple of problems out there. The national energy stuff the global energy is precarious.
What's the role of Europe in this? Could Europe see a recession because of the energy prices?
Absolutely. You know, our economists would say that Europe has slowed down to 2% or something. But the problem with right now, and the economists would agree with me, we're looking at a static analysis. That if things stay the way they are, but you and I know for certain things don't stay the way they are. And my view is there's a very high chance that oil will go higher. It only takes 1 million to 2 million barrels off the market a day that can drive prices up $30 or $40. And so we should prepare for that today. And so, but I like the fact, I think it's great that the Western world has gotten together.
Yeah.
I mean, who would have thought that Putin would get Sweden, Finland, Germany, Switzerland, all of us to, but that working together part, we need to make permanent. For global security.
James, first of all, just going back to the European economy, how quickly could we see a recession, and how deep could it be?
I don't know. I mean, I hate to guess the future. No one really knows the future. I've never seen anyone really guess it well. But again, if Ukraine gets worse, I would assume that Europe's going to go into recession. It may take a couple of quarters, but I would assume that.
But how do you see this ending? And actually, if you're a president of the U.S., if you're a president of the Commission, if you're the Fed right now, you need to game theory, and it could go either way. It's like a three-way system. Mm-hmm. So what do you do?
I would plan for all three of them. I think it's a mistake to guess at which one it'll be. It should be all three of them. And I think basically the Cold War is back. I think the whole world learned something that we always knew, that national security is always the most important thing, but it kind of recedes in the background. We're all doing well. But now it's the most important thing. It should be the most important thing for the rest of our lives. So maybe we all learned that is a permanent state of affairs. The Cold War is back. The allies have to coalesce, and not just for military purposes, but for global economic, strategic investment purposes, so that we've got a safe world. If we don't do that, you know, you see Ukraine, you can see all around the world. You will see forms of chaos.
Chairman and CEO Jamie Dimon speaking exclusively to Bloomberg's Francine Lacroix at the JP Morgan conference. Let's now get to Vonnie Quinn with the first word headlines. Vonnie.
Sherry, thank you. New Zealand Central Bank Governor Adrian Orr has defended the decision to tighten monetary policy ahead of many peers. Appearing before a parliamentary committee, Orr said it took enormous courage to be one of the first countries in the world to stop quantitative easing and start raising rates. Orr has faced criticism in New Zealand for being too slow to respond to inflation pressures. The SEC has added to its broad list of Chinese companies that face delisting in the U.S. JD.com, Pinduoduo and Bilibili have joined those in the regulator's spotlight because of Beijing's refusal to allow access to financial audits. The U.S. and China have been at odds over the disclosure policy for decades, and the SEC is cracking down on firms that do not comply. U.S. Secretary of State Antony Blinken has postponed a key policy speech on China after testing positive for COVID-19. Blinken, who is fully vaccinated and boosted, is experiencing mild symptoms, according to the State Department, and will work from home. The department says Blinken hasn't been in close contact with President Biden for several days. Bloomberg sources say India may restrict wheat exports after severe heat waves damaged crops. Its hottest March on record hurt the harvest the world was relying upon to alleviate a global shortage triggered mostly by the war in Ukraine. We're told top officials are discussing the move and will recommend it to Prime Minister Narendra Modi, who will make the final decision. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Vonnie Quinn. This is Bloomberg. Heidi.
Well, coming up next, Chinese markets are set to reopen on Thursday after a 5-day Labor Day holiday and more negative headlines in the meantime. We'll take a look at what to expect. This is Bloomberg.
Chinese markets returning to action later Thursday after a 3-day break, putting to test to the opens. The benchmark is just 260 points away from hitting a fresh 2-year low, but it really has a lot to digest in the past few days, right? I mean, we saw the Golden Dragon Index, at least when it came to Chinese ADRs, gaining ground today with that broad rally. We also saw a gain last week of more than 8%. So we will see how the Chinese markets factor all that in, despite the fact that we also have more crackdowns from U.S. regulators that are adding more Chinese companies to their lists that could really push them off U.S. exchanges. But of course, we are also watching the offshore yuan because we saw that pop higher during the New York session. This after the dollar saw the biggest drop in about a month, with Chair Powell now sort of downplaying the potential of 75 basis points hikes. We saw 2 sessions of gains right now, holding steady at around that 662 level. So we will be watching for that yuan reference rate fix at the open as well, Heidi.
Yeah, lots of pressures when it comes to Beijing right now. Let's get the latest from our Chief North Asia correspondent, Stephen Engel. So as traders return from the holiday, it was an uneasy holiday across many parts of China. What's the mood likely to be?
Well, I think Sherry just wrapped it up very nicely. There are so many different headlines that have come across the Bloomberg terminal since last Friday's 2.5% rise for the CSI 300. That, of course, on the back of those comments, those stimulus comments from Xi Jinping and the Politburo, essentially saying that they'll do what they can to support the economy. We also got another reiteration from authorities, this time from the PBOC yesterday, essentially saying that they will support normalized supervision of internet platform companies. But again, over the weekend and into the beginning part of this week, a 5-day holiday period, the markets, of course, on holiday for 3 of those 5 days, has been sort of negative. The PMIs were some of the worst readings in a couple of years. We had, of course, the continued lockdown of 25 million people in Shanghai that's into its 6th week. We have restricted movements by for the people of Beijing. In fact, Goldman Sachs says Chinese cities accounting for about 13% of GDP have at least some districts officially designated as either high or medium risk for COVID spread. So you've definitely seen the spillover effect of COVID zero policies onto the economy. And how are they going to stimulate out of that is the big question, and whether there are some concrete. And when I say concrete, I'm not necessarily talking about infrastructure spending. What concrete stimulus measures will work right now to overcome this negative sentiment? Again, we have the Fed's hawkish move. That, of course, potentially limits the ability by the Chinese authorities to ease their interest rates because of the fears of more capital outflows and more pressure on the yuan. So we just ran through it all. There's probably even more headwinds coming.
I mean, Steve, every time we have a holiday, whether it's in China or anywhere else, we're thinking, well, there must be some spending, right, by all these people that actually have a break. That's a problem in China right now, right, when you have so many different restrictions in place. I
mean, even authorities have predicted for this 5-day holiday period, the plane travel, train travel, spending, movements of people would be down considerably from last year's numbers. And we're getting yesterday from authorities the tourist spending was down 43%. Again, you know, China has really three main holiday periods where people move en masse and they spend en masse. You have the October National Day holiday, you have the Lunar New Year holiday, and then the 5-day Labor Day holiday. Pretty much non-existent this time around because of the restrictions of movement. The authorities were telling people, do not go. Unnecessary travel is not supported whatsoever. So tourist spending down 43%. Also, the number of trips in China fell from 230 million trips a year ago down to 160 million. Shanghai still locked down. As you see the footage of the highways, very little activity. Beijing not in technical lockdown, but limited movements for sure.
This is a problem, though, isn't it, when you have people taking leave at these specific times rather than spread out across the COVID cases for May 4th, with 261 local confirmed COVID cases for May 4th. That's according to CCTV. And this is really, even though as we continue to see these case numbers trend lower, that lockdown exit, the exit from a punishing 5 weeks of lockdown conditions being delayed by the fact that we still see these COVID-19 infections persistently appearing in community transmission, I should say. So that hardline strategy continuing when it comes to isolating all positive cases and close contacts. So we continue to see these restrictions in place in Shanghai. We continue to see these extended restrictions and measures being taken in Beijing as well, Sherry.
Right, Heidi. And coming up next, the case of the fallen billionaire investor Bill Huang has led to a rise in federal probes and investigations into questionable trading practices on Wall Street. We get the details next. This is Bloomberg. Federal investigations into questionable trading practices are on the rise, and the fate of Bill Huang and his firm Archegos may await others in the finance industry. Bloomberg News executive editor for legal Tina Davis joins us now. Tina, what does Huang's arrest show us about the crackdown on these alleged financial wrongdoers?
Well, it says a couple of things. First of all, the thing that was repeated multiple times in the press conference when this was announced last month was the speed at which this was done. 13 months may not seem very quick to you and I, but in sort of prosecutorial land and regulator speak, that is a huge and a really fast outcome. The other thing that it shows us is that this is one of 3 ongoing probes that we're aware of. Bloomberg News has written about the short selling investigation that's going on into whether or not there is some collusion or information passing back and forth among short sellers and people moving those trades around short selling reports. And it's also got to do with the investigation into block trading that's happening simultaneously. That is somewhat linked to the Archegos deal in that apparently some banks were complaining and Archegos was complaining as well about the idea that some of the banks they were using to trade huge blocks of shares were potentially letting that information out in advance, and they felt like they were being traded against. So it says a couple of things about both the number of investigations that are going on, the speed of the investigation, and the last thing I'll mention is the prosecutors were highlighting at the press conference that they were going after individuals. And this marks a change in what we've seen out of the Justice Department before.
How is the Biden administration dealing with white-collar crime?
Well, it speaks to, as I was just mentioning, the idea of going after the individual. If you look at the history of the Justice Department, there has been, since the Enron Corp disaster, there has been a real aversion to charging individuals. It's very hard to do, first of all. It's a lot easier to charge a corporation rather than individuals and find them guilty. So we've seen, there's a whole book written about this, and I won't use the swear word in it, but we've seen the sort of chicken excrement club, which is what it's called when prosecutors are unwilling to go after tough cases because they want to keep a really good, strong record of convictions. And now what the Biden administration has said, going back to last year, is that they want to bring individuals to justice, not just have corporations sign deferred prosecution agreements.
Bloomberg News Executive Editor for Legal, Tina Davis. Let's get you a quick check of the latest business flash headlines. Life Insurance Corporation of India sold almost 70% of its IPO issue on day one, attracting anchor investors, including Singapore's wealth fund. The long-awaited bumper IPO is expected to be India's largest and fetch around $2.7 billion. Retail investors will be allotted 35% of the shares for sale. Janus Henderson reported more client outflows in the first quarter, with investors pulling almost $12 billion from the struggling asset manager. That takes its streak of net redemptions to 18 straight quarters. The London-based firm also missed estimates of revenue and adjusted profit, leading shares to drop more than 8% in New York. Binance has won regulatory approval from France, boosting its European expansion plans. The world's biggest crypto exchange has obtained a digital asset service provider registration. It's Binance's first major approval from a G7 nation. The crypto firm recently confirming a $105 million investment into France's blockchain ecosystem.
And some stocks to watch now ahead of the open in Sydney. The National Australian Bank is in focus after the lender posted better than expected first half results. BHP is hopeful for Chile's mining future just days before a vote that could change the ground rules for giant copper mines in the country. And watch GrainCorp and Riley Corporation as India considers limits on exporting grains that the world needs. Coming up in the next hour, dark clouds are gathering over global oil demand amid inflation, supply chain chaos, and the ripple effects of the Ukraine war. Bandai Insights founder Vandana Hari tells us more. A slide in Chinese tech firms in Hong Kong is rattling stock markets in Asia. We'll look into that just ahead with Jeffries. Japan and South Korea are away on holidays, but we'll have the market open in Sydney next. This is Bloomberg. Welcome to Daybreak Asia from Bloomberg's World Headquarters in New York. I'm Sherry-Ann.
And I'm Heidi Stradwatts in Sydney. Asia's major markets have just opened for trade, and our top stories this hour. The Fed raises rates by 50 basis points and signals similar steps ahead.
There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings.
Asian stocks are set to follow Wall Street higher as investors breathe a sigh of relief that supersized hikes may be avoided. Plus, China's markets are set to reopen post-holiday break in a test of Beijing's resolve to insulate the economy from its COVID-0 policy.
And yet, Heidi, Japan and South Korea away on holidays today, but we continue to watch the Japanese yen, which is still under pressure today and hovering around that 130 level. This, of course, after we saw strength in the previous session. But interesting that we continue to see the weakness, given that we are also seeing a weaker dollar, which fell by the most in about a month during Chair Powell's press conference, really downplaying that potential 75 basis point hike. So we saw those long positions on the dollar being cut with that press conference, but the Japanese yen continues to weaken, this after already 9 weeks of losses against the U.S. dollar. This, of course, to do with the BOJ really doubling down in its ultra easy monetary policy and those rate differentials being played in and focused by the markets. And take a look at treasuries, because we are now seeing treasury yields actually fall in the New York session, and the curve is steepening, and you can see that right there at the end of this chart. This, of course, after the 210s inverted earlier this year, and we're seeing a lot of fluctuations after that. This, of course, as we saw the 2-year yield dipping below 260 at one point, and now the 210s and also the 530 steepening by more than 10 basis points in today's session, Heidi.
And Sherry, we are just getting the latest numbers out of Beijing when it comes to COVID-19 cases there. We see it holding pretty steady, reporting 50 local COVID cases for May 4th, according to CCTV. We saw that trend continuing to fall for cases in Shanghai as well. Just over 4,000 local asymptomatic cases and 261 local confirmed COVID cases for Shanghai for the same day as well. This, of course, as we continue to see parts of Shanghai still under lockdown, restrictions still underway underway and restrictions being extended in Beijing, as well as mass testing set to resume as we conclude this May Day holiday as well. So lots of negative news headlines for markets to return to as traders get back to work after that elongated holiday from China. So let's take a look at when it comes to the expectations of that relief rally playing out across Asian markets. Here in Australia, we're seeing a pretty good start to the session. In the first few minutes or so of cash trading, we are seeing some of the strongest gains coming through from materials in particular. This as we see that Australian 10-year yield and the 3-year yield seeing a little bit less pressure, as we saw, of course, a 3-year crashing through 3%. We're now sitting just below that at the moment as we see that relief rally, not just for global bonds, but also in equities as well. New Zealand equities higher by about 0.5%. We heard from Governor Orr saying that the move by the RBNZ to be sort of ahead of the curve, or at least more ahead of the curve than its global peers, was, quote, courageous. We're seeing the Kiwi dollar holding a little bit of those gains, but of course, Aussie Kiwi as a pair continuing to come under some pressure, given that we saw that outsized move over 2% stronger for the Aussie dollar against the greenback overnight. The BBDC seeing its biggest intraday tumble since the start of March. Take a look at how we're setting up a little bit of a pullback when it comes to S&P futures. Lots of question marks over the sustainability of this relief rebound, or whether the markets will now just find another way to fret about the Fed trajectory going forward. In fact, some analysts saying that perhaps 75 could still be on the table going forward, or maybe should still be an option, given many think that the Fed is still behind the curve. Nasdaq 100 futures looking pretty tepid at this point, and ahead of OPEC Plus and ahead of expected more sanctions on Russian energy. We're seeing New York crude holding above $108 a barrel, Brent holding above $110. Well, regardless of the fact that it was 50 and not 75, the Fed still delivered its biggest rate hike since 1990. Chair Powell saying 2 more are queued up for the next 2 policy meetings. It was that tabling, though, of 75 basis points that moved the markets the most. Let's get more on the Fed's most aggressive tightening campaign in decades. I want to bring in our global economics and policy editor, Kathleen Hayes. So it's interesting from perspective, right, that you get to try and rank this on the scale of dovish to hawkish. What was your take?
Well, I guess it's sort of like, if you promise your child, this really fancy bicycle, right? And your kid's all geared up for the latest, greatest bicycle, and you just get them a really nice bicycle, they say, oh, they're disappointed. And I think it's kind of how the markets were today, because a 50 basis point rate hike has not been done since 1990. And it's not just one, it's 2 more. Now, granted, the Fed's behind the curve. Granted, inflation's gotten what many people say out of control before the Fed started moving, but it's clear they are now. And in fact, the 75 basis points off the table is not saying they'll never do it, but they're not going to do it, obviously, for the next 2 meetings. But look at Powell's descriptions here. Inflation, quote, much too high. Fed moving expeditiously to bring it down. You get that sense of the urgency that he and his colleagues feel. As for the neutral rate, he said, which the Fed sees to be 2 to 3%, he says it's an estimate. It's not written in stone, basically. But if rates above neutral are required, we, quote, won't hesitate to deliver them. He also said we're a very long way from neutral now. So it seems that he's acknowledging they've got a lot of rate hiking to do, and they are ready to do it. Interesting that Charles Plosser, he's the former president of the Federal Reserve Bank of Philadelphia, was on with us just in the last hour. And he applauded Powell for speaking aggressively about inflation, but he didn't think that this message from Powell today was especially hawkish. Let's listen. And Sherry, I just wanted to underscore, I can remember we spoke to Charlie as recently as December, and he was already, and even before that, he was saying, look, the Fed's going too slowly. They're going to get behind the curve. They're going. This new framework is kind of getting in their way. They would have to maybe end up hiking rates more aggressively. That brings the risk of recession. So we have to give him credit. He was early on that team, not transitory, but look at the worries along with Bill Dudley and some others. So interesting to hear from him that he thinks that maybe the Fed will end up having to do a 75 basis point rate hike at some time.
which markets may not like very much. But at least for today, we saw the market rally. Global economics and policy editor Kathleen Hayes. And as I mentioned, I mean, U.S. stocks soared, Powell pushing back on that more aggressive policy tightening. Let's get some analysis on how Asian markets will react to the Fed's latest action. But also, given that China is set to reopen after a 3-day break, how will they come back? Joining us now is Sean Darby, Chief Global Equity Strategist at Jefferies. Sean, good to have you with us. So a few markets still closed and away on holidays today, but will we see a more positive reception to what was perceived as a more dovish Chair Powell during the press conference as expected?
Well, I think the Asian markets will take the news of a 50 basis point hike very well. I mean, we've had very, very tight monetary and financial conditions over the course of the last week. So a strong dollar, widening credit spreads for both corporates and sovereigns, and the potential for a much higher rate hike has actually given a nice backdrop for equity markets now, because most of that reversed very, very quickly in the last 12 hours. So Asian bourses, I think, will take the news very, very well. As I said, financial conditions were looking pretty difficult almost 24 hours ago.
That reversal in the dollar, especially sharp, where is it headed now, and what will really affect its course the rest of the year?
Well, I think that's really pertinent for our markets. I think the dollar became very, very overbought, and paradoxically almost as strong as it was during the deflation scare of March 2020. So in many respects, the Asian currency should take some good news from the fact that they've been able to withstand a pretty strong dollar. I think most of the dollar weakness from here will actually come from the more major cross rates, yen, euro and pound, because they are anomalously cheap at the moment. But I think in all respects, Asian and EM currencies have held up well, and that probably means that risk assets do pretty well in this time zone over the next 36 hours.
What about China as an emerging markets anchor, not just yuan, but of course the economy in general? What sort of impact do you expect to see, because the news flow just continues to be so bad?
Well, I think in some sense, China's running on a very different set of factors determining its bourses at the moment. Paradoxically, the worse the economic news gets, such as the PMI numbers or GDP numbers, the more the authorities are willing to do U-turns. And I think this symposium with the internet platforms probably is another sign that the authorities don't want to change rates. They don't want to do massive fiscal stimulus, but are actually much more willing to do reforms. And that, I think, actually provides a nice backdrop, possibly after the Congress, for the CSI 300 and hopefully for the HSI as well. So paradoxically, the markets may get things that are not necessarily interest rate sensitive or currency sensitive, but more on the reform agenda, which is generally good for equities.
The geopolitical piece, it feels in some respects like markets are uncomfortably, albeit uncomfortably, but sort of learning to live with this elongated risk now as we see the invasion of Ukraine by Russia just continuing. Where does that leave a player like China?
Well, I think one of the interesting aspects for China was that, again, talking about U-turns, Foreign Minister Wang Yi went on a flight to a series of countries that abstained against voting against Russia at the UN. One of them was India. So in terms of getting a cohesive force, China was very quick to establish that it wasn't just the only one that had interest with Russia. I think longer term, I suspect that the markets are already dividing the world up, and in that respect, for China, it's going to find that not only trade relationships will perhaps be a lot more difficult, but capital flow relationships. And I think that's what's underlyingly concerning most fund managers, is the risk of potential sanctions and the risk of their portfolios being changed, or the benchmarks being changed as to how they can include China in those portfolios. So I think it's a more longer-term capital flow question, really, for investors towards China, rather than perhaps worries about how the sort of Russia-Ukraine war pans out by itself.
Sean, always great to chat with you. Sean Darby, Chief Global Equity Strategist at Jefferies. Let's get you to Vonnie Quinn with the first word headlines. Vonnie.
Heidi, thank you. JP Morgan CEO thinks the Fed should have moved faster in raising interest rates. In an interview with Bloomberg Television, Jamie Dimon said the U.S. economy is very strong and he sees a 1/3 chance of the Fed's actions leading to a soft landing. But he also added that he sees the same chance for a mild recession. India's central bank surprised markets with a 40 basis point rate hike to tame inflation. In its first unscheduled move since the pandemic began, the RBI raised its key repo rate to 4.4% from a record low. The central bank also raised the cash reserve ratio by 50 basis points. Governor Shaktikanta Das said that inflation pressures are becoming more acute, particularly on food. The EU is planning to ban Russian crude over the next 6 months as part of a 6th round of sanctions aimed at Moscow. In addition to phasing out all Russian oil, the bloc's 27 members are also discussing extending that SWIFT ban to more banks and banning